Are you worried that you're spending too much on mortgage? Maybe yes, maybe no. If it's a yes, maybe it's because you realize that you aren't saving too much. Maybe your income is good and maybe your net worth is good. But as you can feel, everything is flowing towards the house, the property, correct? But on the other hand, it's a no. You're not spending too much on mortgage. Maybe it's also because you have paid off a lot of the loan already, and therefore there's not too much of mortgage stress. When you see reports that many Singaporeans are worried about mortgage rates and stuff, you kind of laugh it off, which makes you in a good place in some way or other. Now, today I'm going to share with you some findings on what is the maximum amount that you should push in terms of your mortgage, because I've done a lot of research in cases, and today I also propose my new formula on mortgage affordability. So if you're curious, continue watching. Hi guys, welcome back. Let's start with some forum discussions. How about that? The first one comes out of this. I spend around 18% of take-home salary while maxing out CPF OA. Whenever I read, listen to financial podcasts, they always recommend not exceeding 25% of your take-home. In my experience, this is a good percentage for buffer just in case there's change of bank interest and change in your income. I absolutely agree on that, and let's use this to kind of guess what is this person's total commitment to mortgage. If he or she is committing 18% of take-home and CPF OA, which is at least 1,200, therefore the person is actually spending at least 3,000 per month on mortgage commitments. I think 30 to 35% is a hard max. Would be making serious trade-offs if you go above this level, in my opinion. Again, I fully agree with that comment. 15 to 30% is pretty normal. Your situation may not apply to other people's situation. It's actually quite insane to see answers 5 to 6%. For context, a 3,000 per month mortgage, which is quite normal, spending 6% means the household income is 50k. Mathematically, that's correct, but I can explain more. Because I voted that right now, currently I'm incurring only 5 to 10% for mortgage in terms of my total expenses. And the reason, I've cut down a lot of the mortgage for this home that I stay in. Previously, my home loan was close to $1 million. I shaved it down with repayments down to 500,000, which means actually my mortgage per month is actually less than 2,500. I believe many who vote that they are paying only 5 to 6% in terms of mortgage is because their home loan is also pretty small already. Take for example this, if you have 200,000 and you have a 25-year loan tenure at HDB 2.6%, you're only paying per month $907. Chicken feed to pay off, correct? 5 to 6% of take home, quite possible. Now, I have a further survey to share with you openly. And before I get that, help me smash the like button because it's taken out 2 hours to prepare this for you. And also smash your subscribe, especially like content like this that helps you understand your financial world a bit better. And this finding is actually from my Telegram group, which I'll leave links below also for you to join in. I've actually asked this question. How much percentage do you spend on mortgage? For example, if your family income is 10,000, family mortgage is 2,200, you should vote 20 to 25%. You would see that 30% of people have fully paid homes or don't have a home loan. So they are actually not too worried about mortgage movement. Which means 70% of people have mortgage. And of this 70%, what I would like to box up is 70% of people actually pay 25% and less. When you pay a 25% mortgage, again, 10,000 income, 2,500 per month to mortgage, actually both CPF can easily clear it off already. So there's not much of cash outlay, which is what I typically recommend for households to stay prudent. Then 6% of the total have voted that they pay 25 to 30%. And that's a range where you start to see some cash outflow already. Likelihood CPF cannot fully pay it off. But right at the very bottom, I'll draw your attention. There are 16%. Which if we equate to those who are paying mortgage, that's about 23% of people. They are paying more than 30% of their income towards mortgage. Plain and simple, they definitely own a condo. Because the condo quantum is bigger, correct? And secondly, HDB flats, there's something called the MSR ratio, which caps a person's expenses to mortgage at 30% of income. Speaking of this MSR ratio, let me show you an example, just in case you're not too familiar with it. The same 10,000 income household can buy only a 700,000 HDB flat because of the MSR ratio, you would see the monthly repayment will stretch to $3,000 already. But on the other hand, if they are buying a condo, they can buy a 1.2 million one. The main limiting factor for this situation of a condo purchase for this household is actually the total down payment that they have. I've imputed in this hypothetical scenario 300,000. That's why the max they can buy is 1.2 million. Because in this situation, the monthly mortgage of 5,131 is actually not fully stretching the TDSR ratio of 55%. This is actually a screenshot from our sponsor, Propertyguru Finance, which I'd like to introduce to you. Before buying a property, it's very important to plan for home loan earlier than later. The pre-qualification tool from Propertyguru Finance helps you estimate how much mortgage you are eligible to borrow based on your unique financial situation. Simply click on Get Pre-Qualified and follow with the few simple questions. Up next is a few simple steps to include your basic details and also your income and expenses, because after all, this report is built for you. It simplifies all the latest bank rules and MAS regulations. The pre-qualification report provides the estimated loan amount you are eligible for. It can be used to speed up your viewing as it's accepted by the majority of agents in the Propertyguru ecosystem. Now the next thing to do is actually use Propertyguru Finance's platform to find the best mortgage rates. You can also look for promotions provided by the banks, and Propertyguru Finance partners with 13 banks in Singapore and gets the best mortgage rates in town. Getting the right package will easily save you hundreds of dollars per month on the mortgage cost. So if you're keen to find out for yourself whether it's new purchase or refinancing, to get started, check them out with my links below. Speaking of this, if this household with 10,000 income is paying 5,131 per month to mortgage, gone case already. I think there'll be serious financial distress. So hopefully everyone listening in, we are not on that path and we be a lot more savvy. Many times on this channel, I've mentioned before the 335 property formula. If you haven't seen it, 335, the first 3 stands for 30% of property price. You should have that as your initial capital ready. You want a $1 million home, you should have 300,000 ready. Then the second 3 is actually you should only spend 1/3 of your monthly income towards mortgage payment. And the last 5 is that the purchase price of your new home should be 5 times of your annual income. Now I have a few problems with this formula which I've trumpeted before. The first is actually 1/3 of your income towards mortgage is actually quite problematic. I've seen private clients with an 8,000 per month mortgage and with a 25,000 combined income. There's tax to pay, there's kids to bring up, there's helper. The equation really gets stretched very quickly. Typically, there is little surplus per month, and most of the surpluses saved up needs to come from bonuses. The second problem with this formula is that it doesn't apply to all age groups. When you buy a property as home, likely for many years you're going to stay there, correct? 1/3 of monthly income towards mortgage is no problem. If your income is growing, correct? This 1/3 ratio will gradually shrink over time. It's a bit like growth stock. You can buy a growth stock with a P multiple of 50 times. No problem, because their earnings will grow in the next few years and that P ratio will gradually reduce. So it's not too expensive. If in the next 5-10 years, your income is not likely to grow, it might stagnate or even start going down, then this 1/3 of monthly income could actually become very difficult to survive on. So how to make this formula be better? Let me present something new. We need to segment this for 2 different kinds of age groups, before 35 and after 35. If you are aged less than 35 this year, 335 formula still works, but actually can be relaxed a little. Let's go with the first one. This 3, which is 30% of property price, actually in this situation doesn't really matter too much. If you're buying a HDB flat, your loan to valuation LTV is 20%, just go with it, there isn't too much of an issue. The next thing, 1/3 of monthly income towards mortgage is actually still okay. Actually, the key reason again is because when you buy your first property younger, your income is likely to grow. Let's look back at the median income chart. You would realize at every age group before 45, your income is expected to grow on average. Simple reasons why include: first, you gain more experience in workforce, correct? You become more valuable. Companies know how to headhunt you and give you more than your current pay. Second, retrenchment risk is still quite low, unlike above age 45. And third, health is generally still okay, which means you can easily bring in more income if you are willing to hustle a bit harder. Then the last part is actually times of annual income actually. I've seen many family case studies in my profession advising on finances, and I actually find it still hardly a problem if the situation is a purchase of home before the age of 35. The example we used previously, 10,000 household income, 6 times of annual means 720,000, correct? It's actually still okay. The hard part is usually the initial capital, and that's where grants to buy HDB and EC would contribute to the initial capital for the property purchase. If you have any questions regarding this presentation, leave them in the comment sections below. I'll try my best to pick them up and give a perspective. Again, this applies to age of 35 and before, or if you're above this age, like age 37, but you're still very confident of strong income growth on the horizon, then this 335 or 336 formula as I'm proposing could still apply to you. Now, let's move on to the other segment, which is if you are above the age of 35. I'll tweak the formula to be a 5-2-5-5 formula. It's going to be pretty stringent once you're above the age of 35, and I have good reasons. Typically, this is where I see people make mistakes because this is no longer the first home, and the first home has actually brought in some profits, and the second one is typically one that is an upgrade that costs the family a lot of money. The first 5, that actually represents 50% of the property price. If you are aiming for a 2.4 million condo, the amount that you need to have in capital is actually $1.2 million. Not 30% of the property price, which is just 720,000. You really need to have $1.2 million. The reason I've bumped this up after a lot of consideration is because once you're above the age of 35, you need to think a bit differently towards retirement. There needs to be a focus on being able to pay down this home so that you have a chance to reach financial freedom. I've thought long and hard. 50% that you have in terms of assets for this property purchase is actually not an exaggeration. And if you agree on the principle that one day you need to finish paying off this mortgage loan, it also means that if you are buying a home now at the age of 45 to 50, the down payment that you need to have prepared should actually be even higher than 50%. The next 25 is actually 25% of income only to be spent on mortgage. This is actually a very conservative amount, correct? But again, from our survey findings, those who are paying mortgage, 70% are only incurring 25% or less of their total income into mortgage expenses. And there's another risk. Above the age of 35, the income growth may not be that fast already. Yes, some people still climb very high to senior management. This whole mortgage prudency part doesn't really impact them too much. And not only is it a conservative amount, it's also a very difficult amount to reach, because once you're above the age of 35, your loan tenure could shrink. Right now, I'm at the age of 40, which means to age 65, there's only 25 years. And to show you how it actually works, the estimated monthly repayment, if it's 3% interest, is $7,113. If I reach age 45, the loan tenure to age 65 is only 20 years, which means my monthly mortgage will be $9,983 per month. As the mortgage tenure gets shorter, the monthly mortgage gets bigger. How to solve this? Again, this situation is with a minimum down payment of $600,000, correct? Which means there must be more down paid to cut down this monthly mortgage. If the loan is only 1.2 million, then you realize it's a lot easier. The equation can fit a lot better already. Let's do a quick summary. If you're before the age of 35, 336 formula. The first 3 is 30% of capital ready. This is actually not too important. As long as you have the down payment ready for your bank loan or HDB loan, that should be fine. The second 3 is 1/3 of monthly income towards mortgage. The 6 is actually price of your purchase is capped at 6 times of annual income. What about if you are above the age of 35? Then we go with the 5-2-5-5 formula. The first 5 is 50% of capital ready. You may need to consider increasing this capital readiness if you are even older. The second, 2-5, 25% of monthly income towards mortgage. The last 5 is actually regarding 5 times of annual income. This is again not as important because the first 5, capital readiness, will keep you prudent. Let me know again your questions in the comment sections, and hopefully I've raised valuable points to really advocate on prudency when buying your property. A quick shout out again to our sponsor for today, Propertyguru Finance. Check out my links below for their tool. I'd like to introduce you to this previous discussion I have, which is a reaction to young Singaporeans buying condos early. If you haven't seen it, I'd like to invite you there too. Take care as always. Goodbye.